Okay, awesome. Well, thanks for being here. Today we're going to talk with Vito Mura, Community Lending. I'm Connor Hancock with Community Lending. Today we're going to be talking about some pretty exciting stuff.
Exciting stuff. What do we got?
Level pricing adjustments.
LLPAs.
Yeah, so there's been a lot of talk in the news lately. I think there's been a lot of misunderstanding about what that is. Can you explain what a loan level pricing adjustment is?
So imagine it as risk, right? So when you go out and take a mortgage loan, the lenders will give you a slightly higher interest rate if you're higher risk, as always in the past, and a slightly lower interest rate if you're low risk. So let's say you have impeccable credit scores, 800 credit scores, you're putting a lot of money down, you're buying the perfect single family house, it's not an investment property or something like that. Mm-hmm. So it's basically risk is what LLPAs are. Okay.
So what are they trying to accomplish by doing this, though? It seems like, because I've heard a lot of talk in the news that, and I know it's true, but I kind of want to get your thoughts on it, that if you have higher credit, you're going to get a worse rate than somebody with lower credit.
That's the reason why we're here today is we've got all the news channels playing, hey, the people with the lower credit scores are going to get a lower interest rate, and the people with the higher credit scores are going to be paying for that with a higher interest rate. Yep. And it's simply not true.
Yep. What they did is, they basically broke down this it's kind of like a grid of different loan to value in addition to credit scores. It basically shows which one are going to be hit with a higher pricing, which one are going to be hit with lower pricing. So is this, what kind of adjustment is this? So for example, if it has adjustment of 0.125%, what does that mean as far as what kind of impact that's going to have?
So pretty important question, because a lot of people are thinking, oh, I have a better credit score, so I'm going to pay 0.125 higher in interest rate.
Yeah, a lot of people think this is rates.
Yeah, and this is what they're seeing on the news is like the smoke and mirrors of this red chart, right? But the fact is 1.125%, it's not to the interest rate. It's simply to the fee. It's an adjustment to the fee. So if you were going to take a $100,000 loan, your fees would be adjusted by $1,125. Okay. But the fact is they're physically not paying 1.125% more than the person with a lower credit score. Yep. It's the adjustments from the worst score to the best score. The adjustments have just been reined in a little bit and they're closer. So the best borrower is not getting a deal that's super way better than the worst borrower. They're getting closer, if that makes sense.
Okay.
And when you look at this chart, and this is the chart, and again, we're showing it on the screen, this chart scares the borrowers because they see the person with the lowest credit score getting the best deal, when in fact, this is just the change. This is the change. This is the reining in of the adjustments. If you look at the second chart that we're going to show you now, you can simply see that borrowers with a higher credit score, they're paying a lower interest rate. Yeah. They're paying less fees.
So would it be fair to say that in some sense, while this is some kind of adjustment, people with higher credit scores could be somewhat subsidizing people with lower credit scores? Even though they're going to have still a better rate, they're not going to have as good a rate potentially as they would have before. So it could be a slight increase in fees on people with better credit?
Absolutely. Yeah. The rates or the fees are going up for the higher credit, but essentially what they're doing is they're making the gap smaller. Yeah. And I really want to talk about, if you look at this chart, it's like a 640, 620 borrower with 5% down. Yep. I can tell you, I've been in the mortgage business 23 years. The chances of finding a 625, 640 credit score borrower that uses a conventional loan to buy a home, in 23 years, I'm talking I can count them on two hands.
Not very many.
Because this borrower needs things that typically a lower credit score borrower does not have. They need a reserve balance. Yep. Well, if you had a high reserve balance, you wouldn't have really low credit scores, right? It's just common sense.
Yeah.
Or how about a really low debt to income ratio? That's what you need in order to qualify for a loan with a really low credit score. No, they're not going to have a low debt. There's rare circumstances that I'll see like, hey, we have a 620 borrower that qualifies for a conventional loan. But your loan officer, and that's what we do, they should provide options, right? And typically the FHA loan is better for this borrower.
Yeah. Yeah, I've seen quite a bit of that, and I think I want to get your opinion on this, but I would imagine that the reason for that is, well, number one, FHA is not going to get hit with LLPAs, such as conventional loans.
True, right. This is conventional only, even though the news has been a little weird about this.
Yeah, well, they just don't know, so they're kind of giving you bits and pieces of information, so hopefully we can clarify some of this. But one of the other reasons on FHA is probably the insurance that you're paying. You pay a upfront mortgage insurance, then you pay a monthly insurance, which could, in some circumstances, especially if you have lower credit, get you a better rate.
You're 100% right. A 640 credit score with 5% down, that mortgage insurance is going to be so insane every single month.
Yeah.
It's you're not going to want it, right? Where if you take an FHA loan with the same credit scores, the mortgage insurance is going to be a small percentage of that number.
Yeah. Yep. Okay.
Way better option for your family.
So let's talk a little bit about different types of loans. So, I mean, what are the major things that impact? I mean, it's interest rates are going to be risk-based scoring, basically, is what it is. So it's going to depend on property type, credit score, down payment amount, and see anything else. I mean, obviously loan type, FHA versus conventional.
Well, yeah, when people, we use this big word LLPAs, but essentially when you're buying a home, there's different risk categories, right? And second home is one of them.
Yep.
So if you're buying a second home, it's a little riskier than a primary residence. Investment property is one of them.
Yep.
Right? Well, why? Because in the recession in 2007 and 8, what homes did people lose first?
Yeah. If you're going to default on a house, it's going to be investment property, a second home.
Yeah, you're not going to default on the one that your family lives in, that your daughter has a bedroom in. You're going to default on the second home or investment, just like you said.
Yep.
But other things that that change these loan level price adjustments, it's credit score, it's condo versus single family home, investment, like I said, second home, like I said, a manufactured home. If you're choosing to buy a manufactured home, it's very high risk. It changes the LLPAs, right?
So I had a question about that because I truly don't know the answer to it.
Yep.
So why would a manufactured home be considered more risky? Is it just the type of borrower that typically buys that, or is it mainly second home versus investment property?
I definitely don't think it's the type of borrower. There are $1 million manufactured homes. You can buy
especially in Florida.
You could buy the Mac Daddy on the water manufactured home. I think it's the pool of potential buyers.
Okay.
It changes with property type. No different than condo. Like some people will only live in a condo. There's positives like, hey, I don't have to do lawn maintenance. I don't have to take care of the roof. I don't have to do any of this stuff. I show up, open my door, it's live-in ready. But the secondary market, when they go to sell this, more people are looking for single-family homes. Makes it easier to sell. Condos have additional risk.
Yep.
Okay. What did I mention? Loan level price adjustments are, hey, if you're doing a refinance, what about I'm not taking any money out of my home versus I'm taking money out to go to Vegas or wherever, right, to buy a new car or Maserati or something, right? So there's adjustments on cash out. There's adjustments on if it's rate and term, it's pretty because you're not taking any money out. You're just lowering your interest rate or you're lowering your term. And then purchase of a single family home is the lowest loan level adjustments you can have.
So I have a question about that too, because we're looking at this sheet here. We've got LLPAs on, purchases, and we see all the adjustments on here. And then we kind of drop down and, you look at different loan types. Is it on this sheet or not? I guess it's maybe a different sheet. But yeah, we have the different loan types for second home, investment property. So are these layered risk? In other words, are these LLPAs cumulative?
Yeah.
Oh, they are. Okay.
Yeah. So if you have, let's say you have a 1% adjustment because of your credit score and LTV, and then you're buying a second home and a condo, it continues to add layers to the risk and it continues to increase the cost of the loan.
Yep.
So where does the borrower see that? That's what matters to your family, right? You see that in interest rate. And what that means is your payment goes up. And sometimes you simply don't see it in your interest rate, but you see it in your fee.
Yep.
So you have to pay for that interest rate, which affects your cash at closing. It takes more of it to acquire that loan.
Okay. Now, what do you mean when you say fee? Like, what kind of fee are we talking about?
So it's shown to the borrower in points, right? And now points are confusing to most borrowers because they're like, well, what is a point?
Yeah.
The easiest way to explain it is 1 point is 1% of the loan amount, right? So to make it easy, if you're taking a $100,000 loan, 1% is $1,000, and a $200,000 loan, 1% is $2,000. So if you're paying a half of a point, it's a 0.5% of the loan amount. $100,000 loan would cost $500 in points.
Okay.
So Connor, who actually collects these points? Is this like lender profit? Is this like your loan officer? Is he depositing that money into his pocket at closing?
No, definitely not. So basically what happens is every time we run rates for a client, based on the type of loan they do, the down payment, the credit score, we get a range of rates back with various points. So these points, 1 point being 1% of the loan amount, is actually charged by investors. Typically what we're seeing right now is a high rate of points. And the reason for that being is if you get a loan right now at, say, 6.5% and you're being charged 2 points with it, the reason why you're being charged a high number of points is because the investors know that as soon as rates drop down to 5%, what are you going to do with that loan?
I'm refinancing in 3.5 seconds flat.
Exactly.
Yeah.
So they know that they're not going to be collecting that 6.5% coupon for very long. So they're trying to get paid up front because they know you're going to refi that within a year or two.
Right. And it costs money to manufacture that loan, believe it or not, right?
Yep. And the inverse is true as well. So when you kind of dip down into a low rate environment, you're going to see just the opposite. So investors know that you're not going to refi that 3% loan. So what happens with points? They go down to near zero.
Right, because they want you to take it and they can service it forever, right? That loan's going to stay with them.
Yep.
It's just like most people who have a 2 or 3% today, we're never getting rid of those loans.
Yep.
I'm never selling my home.
Yeah.
Because I will never get that interest rate again.
Yeah, that's kind of interesting. We're getting off topic again, but
it's okay. That's what this is for.
So yeah, I was talking to people about that before because the inventory is so low right now that there's basically no existing homes for sale. So people are having a tough time finding something. So they want to go to new construction, but there's not enough of that inventory either because it takes time to build, it takes labor. So what are they going to do? What I'm kind of looking for is what's going to happen in the future. If rates, they were up at 7.375 back in October of last year. They've dipped down to, 6.4 now, 6.3 maybe, something like that, depending on, how much you put down in credit score and everything. It's still a little high for people to sell when they're holding like a 2.5%, 3% rate. Yep. But what's going to happen if it dips down to 5%? So people are going to go, okay,
frenzy. I
can probably live. Not only are you going to have a lot of buyers in the market, but you're going to start having people sell their home going, I can live with going from a 3% loan to a 5%.
Right,
That's
but you can't live from a 3 going to a 6.25 or
exactly.
7.25, right?
So that's kind of what I'm thinking is going to happen toward the end of this year. Is you're going to have rates continue to dip down as the economy slows, and hopefully we'll see. These won't all go into effect because I know they've kind of delayed some of this right now. But you're going to have more inventory coming on the market. So I think it's going to be a very strong market throughout summer.
Can I talk about an opportunity though?
Yes.
So right now, while rates are higher, there's not a mass amount of buying frenzy.
No.
Right? So you can go out probably today and negotiate the deal you want on the house you want.
Yes.
Unlike it was, a year ago when there was an open house and there was horrible. A line of 72 people.
And 40 other competing offers, well over list. It wouldn't appraise. Yeah.
No horrible. Appraisal contingencies. Yeah. No inspections. You can negotiate a deal today on the house you love.
Yep.
And refinance that when rates come down.
Yeah. Yeah, and you're going to have the opportunity too because they've already come off the peaks, and it's looking at the market every day. And I watch the market every day, and I love watching the numbers.
More than anyone I know.
Yeah, it's a bit of an obsession, but inflation has not come down as fast as the market had hoped. So, but it's coming down. It's peaked at 8.5%, 9% year over year. Now it's down to probably a little over 5%, something like that.
What's acceptable?
Well, it's not what is acceptable. It's kind of what the Fed is targeting, and that's kind of what everyone's talking about. The Fed, I think, is being a little aggressive in its target inflation. They're trying to get it down to like 2.5%.
Okay,
that's not going to happen anytime soon.
Okay,
but I think what they're doing on the other end, which is what they always do, is they overshoot. Because they're looking at historical inflation data. They're not looking to the future.
Right.
So they're waiting for inflation data to come out that's 3 to 6 months old. and they're saying, well, it's still high, so we need to continue tightening.
Kind of late to the ball, basically. The goal's already been made.
They
and
do that
like,
every time.
Okay.
Well, that's one of the reasons why we've had some trouble with some of the banks. Silicon Valley Bank, First Republic Bank, is because the Fed's increasing rates on the front end, and that's where they borrow, and then they lend out on the long end. And if you have the front end rates higher than the long end, you're
losing money every single month.
It doesn't take long to figure that out, that you're going to lose money and be in a bad position. So that's kind of what's going on. But, kind of a long way getting back to what I was talking about is that all this negative news about the market, higher inflation, it's finally decreasing. The Fed's going to overshoot by raising rates too much. That's going to hurt the economy, but in turn, that's going to slow the economy down. It's going to slow inflation down. Right. That's going to be good for rates.
Right, rates are going to come down.
Rates are going to come down.
And then it's time to refinance that house that you maybe purchased today at a good purchase price. You maybe got a 6.5 today, where now you can refinance it down to a 4.99.
Yeah,
right. Yep. Who do you think benefits from today's announcement? Like 5-1, so it's yesterday, right? Where there's this spread.
As far as what now?
What borrower is going to be benefiting from this?
From the LLPAs?
Yeah.
Well, it's going to be the people at the lower end of the spectrum. But it depends on, kind of how much you're putting down and everything like that. But, my view of this is a way to make housing a bit more affordable for people with lower credit.
Okay.
Because prices have gone up so high, rates have gone up so high, it's pushing a lot of people out of the market. And that's one of the reasons why they made the rates between second home and investment properties kind of the same, as people were trying to take advantage of that spread.
Right.
By calling it, one type of property when it was actually
right. Oh, no,
else.
this is my second home. And then it's listed for rent 72 hours after closing. Right.
Yeah. So, but there was kind of a frenzy of, investment property buying and second home. You had a lot of investors that were buying properties, and that pushed people out of the market.
And then primary residents, people who are going to live in these properties and occupy them and have bedrooms for their family, they couldn't do it because there was so many investors. There's so much big money, right?
Yep.
I think I would like to kind of close this out with choosing the right loan originator, the loan officer, the person who's giving you advice, right? Yep. Because if you're choosing the right guy, he's going to give your family options, and he's going to send them to you in writing so you can sit down at the dinner table with your spouse and pick what option is better. Because there's positives to a conventional loan, especially for the lower credit scores now that this is happening. But then when you compare them side by side to maybe an FHA loan, you might choose the lower mortgage insurance and the lower interest rate and the lower payment over this new kind of hot in the news conventional loan thing, right?
Yeah, and it's kind of interesting because every time that I go over rates with a client, well, that's the question I get most often. What is your rate?
Yeah.
And, rates are specific to the borrower, not specific to the lender.
Right.
And so what I tell, and I go over this with every client, is I'll run rates, give them a list of rates with a list of points, and let them know that, you have your choice of any of these rates.
Yep.
It's whatever makes sense for you. If you think you're going to be in your home for years and years and years, you probably, you can buy down the rate if you want to, if it makes sense.
It'll make sense over a couple of years, buying down the rate. You pay extra for the rate for 3 years, and then 27 years of a lower payment savings, right?
So, it's all about giving them options, kind of like you said, and let them make the best decision that works for them.
Right. Yep. And I've never been the guy who's like, this is the loan you're taking, right? No, I'm like, here's your options. You tell me which one's best. And sometimes it's like, here's a 5% down, 10% down, 15% down, or 3%, whatever the borrower is. Which one's best for your family, right? And then they choose. And talking about rates, it's like, even when you give that borrower interest rates, if they don't have a home picked out and they're not under contract, how often do those rates change?
Yeah.
Every hour?
Throughout the day. Yeah.
Okay. So I think I really just wanted to take this time with you because of everything I'm hearing in the news. It's so difficult. There's a lot of spin going on, right?
Yep.
And most importantly, anyone can visit community lending. FL.com. Mm-hmm. There's a list of loan advisors. Pick up the phone, call any one of those. If you have any questions about anything that's going on, obviously Connor Connor's been on the back end of mortgages, actually with Wall Street, right?
Yeah, I was a professional money manager for over 15 years, where I basically managed a bond mutual fund. So I traded mortgage-backed securities, corporate bonds, treasuries, agencies, pretty much all that. So have a pretty deep knowledge of all this.
Mass amount of knowledge. In fact, I've been in the mortgage business 23 years, and I go to Connor for some of the back end stuff. That was always just like, it was like Mars to me. I just didn't know it. So reach out to one of us at Community Lending, and we're here for any time.
Excellent. Thank you.